Stefan. I don't know whether he's able to join, and I did invite your other friend. Is it Anu? Hang on, let's have a look.
Anu Basu, correct, yes.
Anu, yep, so Anup's there. Okay, so I'll start admitting all and then we'll start, yep. Hang on.
Great, excellent. And then at some point, I think, like I said, if you could connect with Sally Sweet, she might be a good person to interview as well. So.
Absolutely, absolutely. Good morning, Ian. Good morning, Chris. Good morning, Michael. Good morning, Eve. Good morning, Anu. Good morning, Bob.
Morning, Steve.
Slight. Yep, there we go. If you've just joined, if you could mute, please, that would be excellent. Welcome all. Welcome Paul. Welcome Simon. Welcome Mark. Just to cut out any background noise, that'd be great. Thank you very much. That's great. Thank you. Yeah, we've also got Aaron is obviously presenting today. So welcome to Aaron. Aaron is dialing in from the east coast of the United States at what time is it there, Aaron?
6:30.
6:30. So big clap for you, Aaron, for getting up early for us. That's very, very kind.
Well, thankfully, it's daylight saving, so I got an extra hour of sleep. So
you've got an extra hour of sleep due to daylight saving. So there we go. Before we start, a lot of you are regulars on Pension Playpen, so welcome. Thank you very much indeed. If you're not used to Pension Playpen, then we record the sessions for people that cannot join at this particular moment in time. And the recordings will be available this afternoon. So before we start, can we have a thumbs up, Eve or Michael or Henry or Bob, to say everyone's happy to be recorded? There's a lot of background noise there. Maybe Henry, that might be you, but let me mute partly there. So there we go. That's good. I think we're ready to go. Obviously, we're delighted to welcome Aaron Muralidhar as our guest speaker today on the wonderful world of, I would say, sort of global pension solutions, Aaron. I'm going to give you a global pension solutions sort of tag this morning. But I think the UK's got a lot to learn from what you're doing globally. And obviously, if you've got any questions of Aaron, please interact with us and raise a hand. Let's get some questions going. So without any further ado, I'll pass you on to Aaron, and he can start his presentation and thoughts. So over to you, Aaron.
Terrific. Thank you so much, Steve and Henry, and to all of you for joining in on the session. First of all, happy Halloween. And sadly, we're talking about a scary topic, which is pensions. So it seems pretty appropriate that we did it on the 31st of October. Just very briefly on my background, I used to work for the World Bank Treasury, first issuing bonds for them in the early 1990s, and then I moved over to managing their pension fund. And how I got into the pension reform debate was, if you recall, in the late 1990s, the World Bank was going around the world telling people to privatize their social security systems because Chile had done that. And I was sort of removed from that whole discussion because I was one of what they call the technocrats. And I happened to be sitting in a conference in China back in 1997 or 98, I believe. And I heard my economist friends telling the Chinese to privatize their social security because we had just visited the Shanghai Stock Exchange. And with all the flashing bells and whistles, the economists got all excited thinking people are going to make tons of money in their DC plans. And so I got into a huge fight with them saying that you have such a spectacular defined benefit pension plan for yourselves. How can you tell these people with no financial training that they should risk their retirement on the market when they, basically didn't even have well-defined financial instruments? Long story short, the World Bank refused to listen to me, and they went and ruined retirement in a number of countries in Latin America, Eastern Europe. And the smart ones didn't take their advice. But I left and I wrote a book with Professor Franco Modigliani, predicting the looming crisis when you transfer from DBs to DCs, primarily this reason, which is you have people who can barely answer questions on compounding and inflation, and the math required to come up with an effective pension plan in a DC system, is far beyond the average person. My own background is don't sort of fault me for this, but I have a PhD from MIT, which really didn't teach me a lot. I'll be very candid. In fact, probably all the finance I learned there I've learned is wrong, and we can go into that in more detail. And my own 401k, and I manage pension assets for a living, which I've now been doing for about 30 years. My own defined contribution plan is a complete wreck, and I trade assets every morning for my clients, and yet I cannot make the right decisions to have an effective retirement. About 10 years ago, Kathleen Kennedy, the daughter of Bobby Kennedy, came to me and said, we've got a huge problem in this country, which is that at least 50% of the population is what we would call uncovered, namely that if they are offered an employer scheme, they don't participate in it, and over and above that, people are just not offered a retirement scheme to be a part of. Let's say your Uber driver, or the person who cuts your lawn, or the lady who helps, clean your house, or whatever it might be, and can we do something about this? And so I primarily spent most of my time on the DB side of the business, and as I started to look at the DC side, I realized there was a massive problem, namely that just because we shifted from DB to DC, the objectives that we have in retirement haven't changed, which is we would like to be able to have a safe sort of retirement lifestyle, right? To continue your pre-retirement lifestyle into post-retirement. And just because we went from DB to DC doesn't change that goal, yet the responsibility and the complexity is all now being shifted to people who are incapable of doing that. And so I'm going to show you a few slides that I recently presented to a group of about 7 country treasury officials who are meeting together. And what was interesting is in the United States, there's a group called the DCIIA Retirement Research Council. And I would love for somebody, if they could, to do this in the UK as well, which is they ask people, what are your preferences in retirement? And what's interesting is, they talk about steady income, safety, lifetime income, control, access, and reversibility. And then high return is right here with just, basically a trivial percentage of the population doing this. And last week, I tried to run a poll on LinkedIn to see how global this might be. I haven't had a ton of success, to be honest. So at some point, Henry and Steve, if you could run this in the UK, I would love to see if this is any different. But considering how forceful and adamant poor Henry has been about converting pension pots into income, my guess is your results aren't going to be very different from this. So this raises an interesting question, which is if people have this as their goals, how are we serving them by the products that are in your typical defined contribution pension plan? And interestingly enough, in the last few years, I've been appointed as an investment advisor to the Virginia Retirement System's defined contribution plan. So I'm on the advisory committee, and I also was advising a $225 billion or a 225 billion euro Dutch pension plan. And so in today's presentation, I'm going to touch on a couple of interesting issues in the UK and the Netherlands as well. But all of these, I'm guessing, would have very similar preferences regardless of country. And just one other point, at any time, if I'm saying something that doesn't make sense or you disagree with, please jump in and participate, because otherwise it's a bit boring for me. And Henry and Steve know how much I love a debate. So no offense taken, however tough the question might be. So here's what I started to realize when I started to research this topic is when you transfer this risk over to individuals, you're asking them to make a whole bunch of very, very complicated decisions, which is how much to save, how much to contribute, where to invest it in, how should I invest it in, when should I rebalance? This is way beyond the capacity of even professionals in our industry, right? And then I think even in the UK and the Netherlands, self-employed people, for example, aren't typically covered by these employer-provided schemes. So today I'm going to spend a lot of time on what we call second pillar and third pillar systems. Second pillar being employer provided, third pillar being your own private savings. And so if people are uncovered, then you've got a big issue, because now they're going to get to retirement and there isn't a pension pot to even begin with that you're going to try to convert to income. And then finally, the really tough question is, okay, I get to retirement, and now what standard of living will my savings provide me, and how do I decumulate? And so I started to think about, my kids. My oldest son is 24. He started to work. Why can't he start to think about the standard of living at the age of 24, as opposed to having to wait all the way till 63 and 64 before he can start to plan that in? And what I realized is in the investment reports that I get, and then I look at my wife's investment reports because she's in a defined contribution plan as well. There's a lot of nonsense provided. In fact, her recent statement came and it had something like 18 pages on what's the volatility of the portfolio, what's the diversification, a list of rates of return of just about every investment product, which is complete garbage relative to the really interesting question is what standard of living can she have? Which then raised the question, is there a way I can convert literally every month or every minute the amount that I've got in my pension pot into some tangible sort of retirement income that I can expect to lock in when I get to my retirement age, right? And so this was the dilemma that I faced probably about 9 years ago as I was thinking about this problem. And so I was fortunate to work with Professor Modigliani, and as all of you have probably read at some point in your economics classes, the life cycle hypothesis. His whole theme was the reason we save is because we have income during our working lives. But he just made the simple assumption, but we have consumption that stays flat, let's say, throughout your life. And so the goal is to take some part of this income, invest it in a portfolio, and then when you get to retirement, be able to finance this stream of pre-retirement lifestyle consumption as well, right? And so let's assume that your first pillar is giving you this blue set of bars. But in most countries, you could argue that that first pillar is not providing an adequate retirement income. And the first book we wrote back in 2002 essentially said that all these pay-as-you-go first pillar systems are essentially going to end up as a huge disaster because of the aging of populations, right? And at some point, if you want to go into first pillar schemes, I'm happy to do that as well. But for today, I'm going to try to figure out how do we fill the gap between what the first pillar provides and what you want out of retirement by sort of optimal use of the second and third pillar. Okay? So that's the problem. So we have about 40 years of working life, which is what Franco had hypothesized. And then we have about 20 years of average life expectancy that we're trying to use as the sort of drawdown period over which we will have retirement. And for now, if you'll allow me to make the assumption we know that we're all going to die in 20 years, I promise either in my presentation or in the Q&A, we'll take up longevity risk because people are obsessed about longevity risk. And I'm going to argue actually longevity risk is a relatively trivial problem to the one of converting a pension pot into pension. As long as Steve and Henry don't stop me, I'll assume everybody's good. And so here's what we get is if we look at our current set of retirement assets, and it's typically stocks or bonds, in the DC accounts. So if you look at the Nest portfolio, you have those types of instruments. And then in Nest, I think, and especially in the United States, we have this completely idiotic product called the target date fund or a life cycle fund. And I'm happy to tear into that in more detail if you want in the Q&A. But essentially, we're putting aside little pieces of our savings throughout our working life. And then we hit this sort of goalpost, at this red line, which is the retirement date. And this is what we want to lock in. And in the typical approach, what happens is that we're sort of asked to make, a one-time conversion very close to retirement of taking this entire pension pot into the stream of income, which is a highly risky strategy, right? So as a trader, we would call this pin risk, which is the day of conversion. If it just happens to be a day on which interest rates are supremely low, then your retirement income is going to be terrible. Whereas, now we're benefiting from higher interest rates. And so, the amount of retirement income you can get today compared to 2 years ago is incredibly sort of different. And so what this does is for two people with identical sort of retirement contributions, identical investment portfolios, could have completely divergent retirement outcomes just because of the way in which the interest rate risk is all concentrated on one day. So along the path, if you keep sending me these stupid reports which say this is your portfolio value and this is the volatility of your assets, you're telling me absolutely nothing about what is the retirement income I'm locking in. And so the question is, what is the correct approach? We really want retirement income certainty. We really don't care about wealth, right? And so the first thing I want you to start to think about is all the reports that you get just ignore the wealth number that they report to you. All you got to be thinking in terms of effective retirement is what kind of an income am I guaranteed for the period of my retirement, right? Any questions? Because this is the most critical stage. If we agree that this is what we want, and this is, I think, Henry's key point about how do we convert pension pots into income. Once we agree that pension income is what we want, then I'll start to show you how every asset in the market is. Any questions?
We have a question from Bobby Ridaway. Bobby, do you want to unmute and ask Aaron or make your point?
Yeah, so my question point is the assumption that everyone's going to retire. So I think the third pillar should actually include the fact that I'm already seeing this quite a lot in real life in the UK. The assumption that people are going to retire is one that's an old-fashioned one. I think a lot of people are going to work into retirement. So using that money as well in different guises. I've actually seen somebody a few months ago actually who retired a few years ago and actually come back to work, not because they needed the income, but actually because they were healthy and they were just too bored. So just throw that into that piece, really. Just comment.
So in fact, Professor Merton and I have written another paper which we call I think it's called the 6 Pillars of Retirement, and clearly having elderly individuals continue to work either because they need the retirement income or because we've got a labor shortage. For example, looking after children, if women have to be able to participate in the labor force, and again, gender pension inequality is something I'm working on extensively, and we can take that up separately. But if women have to be able to come back into the workforce and contribute like they're capable of contributing, then we do need grandparents to look after children. So there are different roles for seniors to be playing if we are going to be able to make this sustainable. So for now, if you don't mind, we'll leave that aside only because I'm trying to focus on really the big issue, which is how do we just get away from the nonsense that we're in right now, which is this focus on wealth and wealth-related products. And I'll come back to all these other issues. But yeah, in fact, I would say the bigger issue is gender pension inequality, right? Because women take time off to have children. They not only get lower salaries coming in, but then they also end up living much longer. So that's, I think, a much more critical societal issue than adults working into their retirement as well.
Okay, Aaron. Before we move on, we've got Henry's had his hand raised for a while, and then Chris Giles as well. So Henry, on this point, do you just want to ask a question, then we'll come to Chris?
Yeah, in previous conversations, Aaron's mentioned that longevity was something that could be incorporated into the products. He's now saying that longevity doesn't matter very much. Which is it, Aaron?
It's both. It's both.
Right. Okay.
Yes. And I'll show you that in a second. Because if you design this product that I'm going to talk about in a second, then longevity applies to a very small percentage of the population. Okay, so I'll come back to that, and I promise, and Henry, hold me accountable to that if you don't mind. I'll work you through the statistics of that.
Are you saying that the kind of people this is targeted at aren't going to live beyond 85, so you might as well not worry? Is that more or less your view?
Well, yeah, so when I started to work on this, and in fact, just yesterday, I saw a very interesting report on the UK, whereas poor and ethnic groups not only have lower longevity than the average, but they also have smaller pension pots, right? So when you design this product to cover the poor and the minority communities, then what you're left with is the rich and the elite whose longevity you have to worry about. And then there's going to be the elite within that who can basically self-insure. So I'm not going to buy an insurance contract, right? And even if I live to 105, I think I've got enough savings. So you're talking about probably at best 10 to 15% of the population who have to worry about outliving their savings. Why worry about 10 to 15% when we've got to worry about 100% to begin with, or at least 80% to begin with, right? So it's the 80-15 problem. And I've worked out the number, and I have a solution to that.
I'm coming around to your view, actually. Certainly, I know one or two people who've got the same view as you, which is that longevity is a rich person's problem.
Yes, exactly. Yeah.
Okay.
And actually, there's a way to solve it, right? So if you don't mind, I'll stay with this where we know longevity, and I'll show you two solutions with just this existing solution. And then I have a third solution, which is an extension of what we're doing, which is what I call a longevity index variable expiration bond, or a live bond. And you can hedge all the risk that you want for actual longevity. Okay, so for now, we'll just leave longevity aside, but yeah, if you'll give me that for now, we can come back to it.
That's fine. Chris, is your question about longevity or something else, Chris, before we move on?
It's something else. It's the basic. I put a note up in the chat. Essentially, I've posted recently, those who follow me on LinkedIn, on the subject of if we were designing a new DC system today and we'd never had, I'm thinking of this in the UK context, if we'd never had compulsory annuitization, in other words, if we were just building a system that would deliver an income in retirement to which individuals have contributed through their working life, you wouldn't design the current system, which essentially creates potential cliff edges around pot conversion at retirement. What you would do is you would, and this goes partly to where Aaron, I think, is coming from, and we should be talking about delivering income, not accumulating savings. Accumulating savings is, once again, for the rich man. For the mass market, it's about delivering a retirement income. And the best way of doing that, if we accept where we are, people have been saving pots of money, is that we get the key decision point brought forward from their retirement date to say 10 years before, and we move to a to and through system whereby you convert their portfolio not to wealth creation but to income creation going forward. And that would open up opportunities for your selfie to be bought on a, let's say, a 10-year deferred at age 55.
No, so Chris, I'm going to disagree with you on the last point. I don't think you have to limit it to the last 10 years. And I don't think that that's a good solution, because why restrict my 24-year-old from locking in retirement income if he doesn't have the risk appetite to do it, right? So you can issue this, and I'll show you what Brazil has done, which doesn't limit it to this idea that you only need to start thinking about retirement at 55. We've got to get them thinking about it at 24, because that's the only way you not only get their savings up, but then you can actually lock in good events. And I'll show you this in a second, right? So this is, again, one of the sort of remnants of this system of instruments that we have today, which is, Chris, what Chris is saying is the reason you start to hedge at 55, and this is what Professor Merton had written, which is when I responded to him saying that's not good enough, is if your maximum maturity of your bond instruments is 30 years, then, and you've got 20 years in retirement, that only leaves 10 years pre-retirement to start locking things in. And that's highly inefficient, right? So there's no reason to limit your instruments to 30 years. It's just that nobody had the creativity and the imagination to say why limit it to a 30-year instrument. It's because those instruments are badly designed, which I'm going to show you in a second, that we start to have all these complications. So Chris, there I'll disagree with you, which is let's start getting people locking in retirement income at 22 if they want to. Why limit it to 55? Right? Now, the pension pot may not be big, but then that's how Brazil has actually addressed it as well by their design. Okay? So I think we're in agreement, and I'm sorry, I can't see the chats or the hands because I'm sharing. So Steve,
that's all right. That's fine. We can move on now. I think if Chris is happy with that, maybe some of your,
Well, not entirely. I was going to say not entirely, but it's an issue really about the pricing of a long-dated bond. I mean, essentially,
not a problem. Not a problem.
I just think in the UK, given the experience, you'll get a lot of. There are alternatives in the UK, Aaron, which you may not be aware of, particularly for the self-employed, called lifetime ISAs.
I am very aware of it, right? And in fact, my former boss is Harriet Baldwin, who's the MP, who's the head of the Treasury Finance Committee. So I have been following the market very closely. And even Nest, for example, is a very poorly designed system, in my humble opinion, right? And we'll come to that in a second. Because again, they had all the excellent sort of structures for the accumulation. Australia is another great example. All the focus on accumulation, but they call it a superannuation fund. There's a lot of super on the side of accumulation. There's no annuation. And I think a DC system has to be all about annuation, less about accumulation. I think, Chris, there you and I agree, but we'll come back to that in a second, right?
Yeah.
So let me just move on ahead, and then we'll sort of, tear it all apart. And if you can convince me, I'm happy to switch sides. I've got no sort of, I'm not wedded to anything I'm saying right here if I can find a better alternative. So typically what we have in these gilts that you're going to buy is, you buy the bond today, it pays you a string of coupons, and then after retirement, it pays you some more coupons, and then it's got this big stub principal at the end. But look at how different that is from the cash flows that I want, right? So if you're buying gilts, and I think somebody was trashing me the other day on LinkedIn, Henry, saying that I don't buy a single gilt, which I think is a bad decision per se. But in a way, he's smart because now you've got to take all these coupons and then move them into the retirement. And then you've got to take this big stub principal and then also spread that out. That's a lot of small sort of transactions which are complicated, very expensive, and therefore very inefficient. So your typical gilt is very risky relative to retirement. So any product that says, oh, I'm going to take you from stocks into bonds as you age, is just moving you from one risky asset to another risky asset and doing silly things. And I think Nest has one of these life cycle products in its lineup as well. And in the US, it's the default option, which means that if you put people in that product, they can never sue you, even if they get a completely sort of ridiculous outcome. Now you can complain and say, Arun, I want real retirement income. This was a nominal bond you plotted. So thanks to my friend Georgia, who helps me with all these graphics, there's a mismatch again, because again, what does an inflation index bond do? It gives you a string of coupons, and then it gives you the sort of inflation adjustment all the way at the end. And so you can see that the biggest risk in retirement is not only standard of living risk, but with all these instruments, you have tons of reinvestment risk, and you're not sort of easily able to convert these coupons into future income. And if you change your mind, that's going to be prohibitively expensive, which is why annuities are not easy to sort of change if you decide I want to retire at a different date or I want a different stream of income. The annuity provider has to take all these complicated transactions and move them around. So they're going to stick that price on you. Okay? So this was the main point, which is if these sets of instruments, which typically have been considered the safe assets in retirement accounts, are actually very risky, then the question is what next? And I'll stop here because I'm basically saying everything in your DC account today is a very risky asset relative to your desire to have a guaranteed real retirement lifestyle. And I'll stick with lifestyle rather than income. Any other comments or questions that I'm missing?
Not at the moment, no. Just to double check. I mean, Henry, you've still got your hand up, and Chris has got a hand up, but not at the moment, Aaron. So you can. Oh, Steve, right? Steve, do you want to ask your question at this time?
Hi, yeah, I'm a relative newcomer to this. Actually, I've only ever sat in on one of these before. I'm a previous collaborator with Andrew Smithers, who spoke a few weeks ago. But I've done some work on this. I suppose my response to this, I'm one of these economists that Arun thinks have crazy ideas. And I mean I'm very sympathetic with what he's saying. But I suppose to me an obvious question is, aren't you just saying that DC funds should be like DB funds?
Well, no, I'm not saying that necessarily, because the benefit with the DB fund is you have a residual claimant, which is the employer, right? So what we've done in this system is we've actually transferred risk from the institution that was able to, aggregate many people. And one of the benefits of a defined benefit-based system was because you had mandated participation. Annuitization became cheap to provide, right? This is the certainty equivalent argument in economics. And I'm sorry, I'm an economist too, so when I trash it, I'm trashing myself. But what happens in a DC system is now you've transferred it to the individual, where you have voluntary decision making, so that people can decide when they want to enter, when they want to exit, they can have choice of portfolios. So what Franco and I showed in our book is the only difference actually between a DB and a DC scheme, if you actually think about it, is that in the DB scheme, effectively the rate of return in your assets is guaranteed, and you can work out the math, and I proved this back in '98. Whereas in a DC scheme, that return is volatile. Those are the only two differences between a DB and a DC scheme, because contributions are volatile in both, benefits are whatever the accumulation provides. So the only difference is whether or not the return is guaranteed or not. And that's the difference between a DB and a DC scheme. Apart from whether they're mandated or not, because typically DB schemes are mandated, DC schemes may or may not be mandated, depending on which country you're in.
I guess the follow-up would be that DB schemes, at least on paper, make risk-free promises, but they actually in recent past haven't been able to fulfill them. My USS scheme has essentially had to, roughly speaking, halve its benefits because it just couldn't afford to offer the benefits anymore. And the problem with this is I obviously everyone wants risk-free retirement, but the aggregate amount of risk-free assets is actually rather small.
Well, so there's two interesting comments you've made there, right? One is I would agree with you that the DB schemes have to cut benefits, and that's identical to a DC scheme, right? So from the benefit point of view, even though we call them defined benefits, they're risky because in the Netherlands, if you didn't have an appropriate funded status, the regulator would actually ask you to cut benefits, which is actually a sensible thing to do, right? We don't like it, but in a classic sort of financial management, risk management perspective, if you don't have enough money and your rates of return aren't adequate, then you've got to cut the benefits. That's the only way that equation balances out. Now, I'm going to make, again, a very, very sort of controversial comment, which is the reason a lot of these DB schemes are in trouble is because finance theory got it completely wrong with the starting assumption that investors maximize the utility of wealth. In a DB scheme, you want to maximize the utility, if you want to call that term utility, which I think is also nonsense, but you want to maximize funded status, which is assets over liabilities. And so because we had such a wealth focus, what people were holding in their portfolios in DB schemes were assets like this, which are actually incredibly risky, even though they look safe from a wealth perspective. Because let me take a DB scheme, right? In a typical DB scheme, let's say in the UK, your average duration of your liabilities, again, I'm sort of getting a little bit technical here, is about 14 years, right? So that's why a lot of the DB schemes were buying long-dated gilts. If you start holding a duration of 4 or 5, you're basically playing the Silicon Valley Bank people were playing in, right? So a lot of your portfolios, and you have these consultants, and I don't mean to trash the consultants, but it's the academics who set off us on the wrong path, including Bill Sharp, who's actually agreed with me on a number of points, that because people have this wealth focus, they held assets that had no connection to what their promises were to pay liabilities. And I know Henry doesn't like me saying this, which is holding stocks in a DB plan isn't always the best bet. Yes, that's true, Henry, because you've made a commitment of cash flows to be paid out. Holding stocks relative to that is risky. And if you don't have somebody who's willing to bear that risk, then guess what? You've got to be hedging out and get out of equities because that's the smart thing to do. From a pure financial risk management point of view, if somebody says, listen, USS says, I can bear that risk because if there's a disaster, I've got plenty of cash on the sideline that I can push into my pension system, then hold all the equities you want. But if you don't have that risk tolerance, hedge yourself out and be in gilts. But again, don't do what some of these crazy UK pension funds did, which is put the wrong amount of margin, which is shocking that the managers even permitted them to do that, because I manage margin for my clients and I've never had a margin issue, even with a 5 sigma move, right? So this is all mismanagement that has taken people in the wrong direction, even in the management of DB plans. LDI, liability-driven investment, is the core of managing all assets for every goal, whether it's pensions or managing your child's, college fund or whatever. It's got to be driven by what is the reason for which I'm holding these assets, which is basically the string of cash flows, whether it's a DB plan or a DC plan.
But sorry, I'll stop in just a moment. But just one final. I mean, I suppose an economist's answer, one economist's response to what you're saying is, it seems to me that you're suggesting that people should just buy forward annuities throughout their career.
No, I never said that. No, I never said that.
But it is implicitly what you're saying, because you're saying they want to buy risk-free income in retirement.
No, I never said that.
I'm misunderstanding then, clearly.
Correct. So if you go back to, again, to Tobin's two-fund separation, right, which is a beautiful paper, it basically says everybody should hold a collection of the risk-free asset and a risky asset. And I'm really simplifying down to very trivial sort of comments because I think it's helpful. Okay, so if we just think about what is the risk-free asset in a DC plan, it's this type of an instrument, right? If somebody has high risk tolerance, okay, so maybe me, then I may hold only 10% of my portfolio in these assets, and I want to try to get the equity risk premium, which has been high in the past. And I think we talked about this at the last coffee time. But there's no guarantee going forward that it is the case. And we have no ability to predict what equity returns are, right? Or any risky asset for that matter. So depending on each individual's risk preference and which stage of their life they're in and what amount of wealth they've inherited and what type of health they may have, there's a whole range of parameters. The optimal mix between stocks and bonds between you and me, even though we may be the same age, have the same income, could be vastly sort of divergent. Okay, so I'm not saying everybody has to hold these instruments. If they want to lock it up, and it could be either a non-tactical view, or what I call a view-neutral view, or a tactical view, then that's up to them. But it's not required by finance theory, and I can prove that to you very easily. Okay? It's dependent on each individual's target retirement income and their risk tolerance, and therefore that determines how much you hold in stocks and bonds. And this is why what happened is post-2000, the tech bubble imploding, and then the great financial crisis, every DB plan got shut down because no corporate treasurer wants to be on an earnings call explaining why profits are down because they have to put more money in their pension fund. And the reason they were putting more money in their pension fund is they held assets that were not even positively correlated with the liabilities. They held assets that were negatively correlated with the liabilities. So to predict a retirement crisis is trivial, because if you do a Markowitz optimization for your asset allocation for a string of liabilities with a duration of 14, you're guaranteed to have a retirement crisis. So that's why the DB system has been
Aaron, I've got to
right?
take issue with you here about all these schemes getting closed down. An awful lot of DB schemes didn't get closed down. The ones that didn't get closed down had strong covenants from employers who were prepared to stand by the open pension promise.
Correct.
Take LGPS as an example, USS is another, and so on. Now, they may have cut benefits, but they stayed open. And it strikes me that what you're actually talking about is that world where there is no employer out there prepared to do anything other than pay money in as part of the remuneration package on a defined contribution basis. This isn't really a substitute for DB, is it?
So, again, I'll take issue with you there for a second, Henry, which is if you start cutting benefits, then basically you're a DC scheme to a large degree. Right? In a classic DB, the contract that you have is that you join and you're promised, and in the case of my World Bank, if you work for 30 years, they multiplied your average last 5 years salary by 30 times 3.5%, which is the accrual rate, and that was what you were promised. Now, suddenly, mid-career, they turn around and say that's actually 2.5. That's cutting my benefit, which is no different from a DC plan in that fashion. And so that's why Franco and I argue that the only difference between DB and DC is whether the rate of return is guaranteed or not. Everything else is identical. But Henry, it would take a really brave treasurer and a CFO, which I don't see anywhere in the world today, to say, I'm starting a new company and the benefit I'm going to offer to you is a set of defined benefits. Because now what you're going to say is, I'm a car manufacturer, but I'm going to have a department on the side which is really running an insurance scheme.
I'm totally with you, Aaron. It's leading you down a rabbit hole, this discussion, because we all know you're right. Yeah. But the point is that an awful lot of people would like to have something which feels a lot more like the state pension than what they've got, which is something which they've got no certainty about. There's a great report by Pension Insurance Corporation, PIC, yesterday, which does a vox pop on its 500 staff, all in the insured sector, who all turn around and say the same thing, which is we want that opportunity to buy, and if we don't want that, we'll make that conscious choice to float our benefits, but give us certainty first. It seems to be what they're saying, which is kind of what you're saying as well, isn't it? For the default situation should be certainty, not the floated benefit. Yeah,
exactly. Yes. And I think, Henry, in a sad way, I was a staunch sort of DB believer, and I think because of the problems with finance theory and practice, we threw the baby out with the bathwater. And this is what the World Bank did really poorly in 96, 97, which is when I was fighting them, is they didn't understand the value of a DB. Right? The market was going up and they thought, oh, the DB gives me a terrible benefit relative to putting my money in internet stocks, right? And again, sorry to beat up on the economists, but this was the naivety of those people. And they didn't realize that if the market crashes, that's when the DB is valuable. But more importantly, even for all of us on this call who are finance professionals, getting that certainty out of decisions we make is so hard with the existing instruments that we'll never get it. And that's why I would love to see the report you referenced, because it's no surprise to me. I'm a professional. I made money in 2008 when people lost money, right? I made it in 2018. I did it in 2020 with, COVID. And I'm still desperate for a guarantee because I'm not sure, I'm going to get it right, because I'm right 55% of the time, right? So I think that's where we come to selfies, right? And so this is hopefully the best transition point. Because my idea was really simple, which is, to Henry's point, if we like the state pension, which is basically when you get to retirement, There's a steady stream of income guaranteed in real terms, right? I believe that's what it is in the state pension in the UK, right? So what I would like is something that matches what the state pension is offering. But what it is I'm going to make it into a market instrument. And so the idea here was that the government would issue a bond, which would start paying on the date of retirement. And so because my date of retirement would be different from Henry's, would be different from my kids, there'd be different bonds for each sort of cohort, which had a different start date. They would pay for the average life expectancy of the country. So let's say in the UK, that's about 20 years. But instead of the traditional coupon that you get on a gilt, which would have been something like 5 3/4 or 6 7/8, which is math that only bond geeks like myself can understand, what I wanted them to do is issue a bond that would pay 10 quid, let's say, a month. Okay? And why did I want that? So if your goal was you want 5,000 quid a month to give you about a 60,000 quid a year retirement, and let's say the state pension gives you 50% of that, so then your balance from pillar 2 and pillar 3 is 30,000. Then your goal, and I'm not saying you should hold this on day one, but your goal now is I want to get 2,500 quid per month. And if I buy these bonds, that means I've got to buy 250 of these bonds, right? Because every bond is paying me 10 quid per month in today's sterling, pound sterling. Right? So let me make sure I get that math correct and simple for you. If I need 2,500 per month from pillar 2 and pillar 3, and this bond is paying me 10 quid a month for 20 years, then I just divide the 2,500 by 10, and the goal is buy 250 of these bonds before you get to this red line. Now, you may buy them all on the last day. You may buy them all when you're 35. I don't care where you buy them. I want you to have the ability to lock that up so that then your retirement lifestyle is guaranteed in real terms at any point in your life cycle. So that's essentially what the bond is we were trying to make sure that we got all the complicated decisions of accumulation, decumulation, compound inflation built into the bond. And we'll talk about how you price this as well. That's not a big issue. But if it's issued by the UK government, and again, somebody said, I'm not going to buy anything from the UK government, God bless them if they can find a better, safer alternative in the UK. But it is low cost and low risk relative to all other options that you would have. And let's be honest, the UK government is never going to default on its retirees. Even Putin was scared when his retirees went on strike. Retirees do vote, kids don't, right? So we transfer all our problems to our kids. It's extremely simple, so you have to answer only two questions. What is my date of retirement and what is my target real income in today's pound sterling, which anybody on the street can answer, and this is the beauty of what Brazil decides. It's liquid because as a bond, you can buy it, but you can also sell it. And this is something Brazil has already shown, that people actually sold the bond 6 months after they bought it for whatever reason. And if you die early, and this is again one of the advantages of this instrument compared to an annuity, it gets bequeathed to your kids who can either collect the income or decide to sell it and just take the principal and walk away. So this is what I thought would make a lot of sense, which is if I'm designing an instrument for the average Joe on the street, it has to be as simple as answering two questions. What is your date of retirement and what is your target income? And so let me just stop here because this is the critical thing. So we called it selfies because it was meant to be standard of living indexed, forward starting, income only securities, right? And so that's where the selfies acronym came from. Any questions? Because I'm sure I've now dropped.
Chris Giles has got his hand up first. Then we'll come to Steve, and then we're going to Bobby. But Chris, you go first, if you may.
Yes, I've been putting a few comments in the chat. I mean, just to come back to your point earlier, Aaron. I mean, I'm basically a supporter in principle. I'm trying to look at this from a practical perspective, having had some contact, albeit not as much as, say, former pensions ministers with the Treasury, who are very stubborn people and very set in their ways in the UK.
Yes.
I mean, the obvious thing to do in the UK would be to, for any if we think about it, insurance companies supposedly match their annuity funds with bonds, government gilts or corporate bonds. but they pay out regular coupons and then they're repaid at the end. In other words, they don't really match a retirement income or an income over a period. They're not a good cash flow match. So you would think that annuity gilts or annuity bonds would be a great idea, but there's a lot of resistance to that. And as I say, former pensions ministers have tried down this route. And essentially, I think it's they must be in league with all the banks and everything over swap transactions and whatever, because basically they make it more difficult than they need to, don't they? I think we'd agree on that.
Absolutely. Absolutely.
Yeah.
You know, I've been slogging away at this for the last 8 years without meeting a lot of these officials. And there's one is arrogance. And again, I don't know what their motives are, but they genuinely believe that what they're doing is okay. But this is where you folks, as the citizens of the UK, have to actually make a stink and say this is unacceptable, because by not doing your job, you're putting British retirees at risk. And guess what happens when that takes place? Is when people retire poor, the government is going to bail them out, which means your taxes are going to go up, because let's be honest, the people in this group are going to be of the middle to higher income category. That's basically it. So they're being completely negligent in their work. And in fact, this morning, you know, I had a sort of aggressive comment on LinkedIn, because Lyle Bernard was my professor at MIT, and she's on the Council of Economic Advisors. The US government is issuing so much debt. Why can't they issue a bond that helps me get a safer retirement? I've met with them, you know, through 3 administrations, and it's just complete inactivity because they're getting away with nothing, you know, doing nothing. So I agree with you completely on that. And so this is where these sorts of groups have to get band together and say, this is unacceptable, because you're putting not only people at risk, but you're putting our future taxation at risk, because we're going to get taxed when this ends up blowing up, which is what happened in Chile and all of Latin America.
I mean, I was going to say, the issue really, I think it's the political system in this country is built around 5-year cycles, very controversial, confrontational, and we don't have any sort of long-term planning in pensions. If we could have, we need 2 things, probably long-term planning, and we need to bring the state pension into it, because I suspect this would gain traction, not necessarily ideal, but it would gain traction as in some way being as a way of looking at the long-term cost of the state pension, and in some sense this being seen as, if you like, transferring part of that cost into which isn't necessarily what, you know, we would want, because a lot of people quite rightly argue that we've got one of the lowest state pensions amongst the developed countries. The only problem is we can't afford anymore.
That's the thing, right? So because you can't afford more, the responsibility now is to be on the individual. But I have to say one thing is the UK, relative to, I would say, 90% of the countries I've talked to, and I'm talking to a lot of countries, okay? So the list is, you know, is a mile long. And in fact, I'm about to meet an official from an Asian country in half an hour. You have Harriet Baldwin, who worked for, you know, JP Morgan. She understood this in 5 minutes. Now, whether Harriet is able to pull it through within all the challenges you have in the current political system is beyond my pay grade. But I think that's where you folks as British citizens have to stand up and say, what is your reason for not doing this, right? As opposed to, why should you do this? And that's what, when I've showed them, it's actually a great deal for countries, right? Let's just skip ahead to a slide. Yeah. So this is why it's a great deal actually for the UK Treasury, if they had the willingness to listen, right? First is it's lowering the risk of people retiring poor. You know, you've heard Jeremy Hunt talk about funding infrastructure from pension plans, or, you know, trying to do VC investments or green infrastructure. Guess what? The cash flows from this bond are the exact offset to what you need for infrastructure, which is you need capital investment in infrastructure. It takes 20 years to get whatever, you know, water factor, you know, what's Thames Water is in trouble as well, isn't it? As are a number of utilities. So if you're going to invest in that, these are the cash flows you would get. So the country is actually hedged. It's getting long-term financing for infrastructure, which again, I heard schools are falling apart, which is a crime in and of itself, but you're now going to be able to get money for that. This matters less to the UK, which is a dependence on foreign capital. You're promoting long-term saving. And now here, I left open the question of what does this bond index to? And in typical cases, like the gilts market, it's indexed to inflation. But actually the real risk of Henry's retirement isn't just inflation, it's that the standard of living is changing. And so if you're planning over a 40, 50-year cycle, and the standard of living is increasing dramatically, if you don't adjust for the standard of living in the payments, then people are going to hit retirement and have a decline in the real standard of living. So one of the innovations that Professor Merton came up with about 30 years ago was to say, these bonds should be linked to per capita consumption. But the simpler way to say that is if you have a value-added tax regime like you have in the UK, these bonds could be linked to a value-added tax index, so that if the value-added tax is rising in terms of its receipts for the government, then your pension payments rise, which means your kids and you can have a similar lifestyle in retirement. Right? And then Brazil has actually used the infrastructure to create new instruments, and I'd also advocated for an education bond, because if you think saving for retirement is tough, saving for education is equally challenging. It's become more expensive in the UK, which is why they're now going and trying to recruit students from India and China. But this is something that could also be done very effectively with the infrastructure. So I think if Treasury is asleep at the wheel, and again, I haven't spoken to Treasury officials, I only spoke to Harriet and her team. This is where Sally Swaite at NSNI, which is the National Savings and Investment Corporation, which is your old postal savings, she heard the Brazilians talk about the success they had. I think NSNI could be a perfectly good alternative to sort of implement the system, because she have less constraints on what she's trying to do relative to Treasury. Again, I'm speculating here, which is why it might be good to get Sally on a future sort of coffee time as well. Right? So it's a no-brainer for the countries to do this. And I think to your comment, why won't they do this? It's because they've got so used to doing nothing different from issuing the standard bond and allowing the banks to capture the profit, which should actually be in our pension put pots. Because every pound of cost is reducing my pension pot as well, right? So if I can lower the cost to zero, why not do it? So okay, anyway, what I was trying to say, sorry, yes, lots of questions, go for it, yeah?
Yeah, Stephen, right, you've got your hand raised, then we come to Bobby, and then Henry's got another question, but go on, Stephen.
Yeah, just, sorry, this may seem like a rather pedantic question, but earlier on I said, isn't this just buying forward annuities? And as far as I can see from your description of it, the only qualification is that they're real, they're indexed annuities, and they're not annuities because they have a 20-year fixed lifespan rather than a decline, probability weighted lifespan. But in terms of pricing, they would be priced more or less the same as forward annuities, as far as I can see. I mean, the bond that you're talking about would be immensely volatile because its duration would be so long.
Exactly. Yes, but who cares about duration?
And how would we cope with the volatility of that bond?
Forget about the volatility. You've been trained incorrectly by the system that focuses on volatility. Look at your retirement income. Your retirement income is unchanged.
No,
so
yeah, I agree on. You're right that people should focus on that. I mean, people like Cochrane and Campbell have focused on that idea, and I think that's completely correct. The problem is, what a person contributing buying these bonds will say, I'm buying myself £1,000 worth of pension in 40 years' time, and all of a sudden it costs me 6 times as much to buy £1,000 as it did 2 or 3 years ago.
So here's where actually it now starts to hold our government officials accountable, right? Because take a look at what happened when the central banks were cutting interest rates over the last 5 to 7 years. Basically what they were doing is they were raising the price of retirement, and they got away with murder, including, our famous Jerome Powell, who said inflation is transitory. Imagine tomorrow if this bond existed, and to prop up the stock market, which was really meant to help the wealthy, right? They lowered interest rates by 25 basis points because the market took a wobble. With a duration of 50, immediately you're going to have a 12.5% increase in the price of your retirement bond. So as a result, guess what? Now people are going to wake up and say, excuse me, you just made my retirement a lot more expensive. So I actually tried to meet with Stanley Fischer. Actually, I met with Stanley Fischer and I'm at a conference, and I said, Stanley Fischer, he was opening it up for questions. I said, haven't you stolen from retirees by lowering interest rates to prop up the stock market? And he said, what do you mean? I said, you made the cost of retirement incredibly expensive, and that's what drove a lot of these DB pension funds into a bigger deficit, right? Was basically that, you were transferring, you were making the liability value higher, much more so the asset values increase. So if you take a look at the funded status of DB pension plans every time they lowered an interest rate, they were propping up the stock market, they were smashing the liabilities by much higher and actually stealing from retirement. So now you have way more accountability if these instruments exist, not only in interest rates, but also in inflation, because if you run inflation hot at 10%, Treasury is going to be mad at you, and you cannot get away by waving your hands and saying it's transitory. So this is where actually this bond creates way more accountability than exists today, because today they get away with murder, but us not having the ability to see the immediate costs of their decisions on retirement and other aspects of our lifestyle. Right?
Okay, Bob, I'm conscious of time, Aaron, as well. You got a thing to do. Bobby, have you got a question? And then we'll come to Henry.
You hear me?
We can hear you, Bobby. Yeah.
Yeah. Okay. So there's 2 points. I'll try and give them pretty short. So first of all, I agree with Chris' point. This will be market price. So it'll be price relative to gilts. So you've got all those issues. So I won't go into that. So they've been covered. My second point, though, is I think we're at least a generation, maybe 2 generations away from people at retirement being able to understand what these decisions are, or even at young ages. I think there's a lot of good work going on for younger generations to start to understand this. And I think the experience of the next 20 years of our age, or even the generation just behind us who retire within adequate savings, is going to work through. So I think that's a future problem. But I think for now, the problem is, even in anything like this, we're going to have to default it. And if we get this into some sort of default strategy with the really big master trusts and it works, then in 20 years' time, you'll see this thing works. And then the people who are then educated enough to make decisions will see that's something else that's working. But I think the main point with this is we probably would need the government to be able to have some differential pricing on this to make it work, because otherwise, if it's used to invest in infrastructure and other long-term illiquid assets, but you're still having to price it relative to gilts, it seems a bit of a missed opportunity.
So let's be clear about this. The bond will be priced like any other bond instrument off the gilt curve, right? The real gilt curve if it's real, and nominal gilt curve if they decide to do it nominal. How the government spends the money is a separate issue. So I want to separate the fact that the users of the fund...
Okay, well, my point there then is that this is priced relative to bonds, and it still doesn't get over the real problem, which is that there's not enough contributions going in. And the fundamental difference between DC and DB in the UK is because when schemes change from DB to DC, they halve the contributions pretty much, or even more. So it wasn't, and I agree with you, with the same level of contributions, DB and DC look very similar, but DC with half the contributions is never going to make up DB. And if it's priced on bonds, there's just still, it doesn't solve any of the contribution problem we've got.
So a couple of points, right? So Brazil actually issued this bond, and I'll send the slides around after the call. I think, Steve, you already have them, but it's been a big success, right? So Brazil issued this bond in January, priced along the curve, basically fully discounted. And they had what they call a bid-ask spread, which is you could either buy or sell the bond at the same price, so the government can't rip you off. And what's interesting here is you actually see people selling these bonds back to the government for whatever reason, right? And they've had a steady increase, and I think as of the 26th, 66,000 people had already signed up, including 15,000 or 13,000 who had never bought an instrument before. But to your point, how do we get people to realize that they're actually falling short? Brazil designed a really simple app, which says, what's my age, right? When do I want to retire? How much do I want to retire with? And I have so much to invest. And essentially what it's doing is, like you have your funded status calculation in the DB plan, every month now you can actually show people a report that says, well, relative to your target, where you are. And in order to get there, either you need to buy more of these instruments, which means save more, because today there's no instruction on saving on your statement, or you've got to take equity risk if you're willing to bear the downside, or you've got to postpone your retirement or work through retirement as well, right? So now you're giving people a sense of where they are. It's like a GPS that says you're on the road, but guess what? You're falling short, so you either got to sort of increase your speed or take more risk or do something else. Today, there's absolutely no ability to tell people what's the right contribution, because there's no ability to tell them what they need to lock up a guaranteed retirement income. And so the mess that we've created should not be the basis of the new system. And Brazil is actually allowing you to do this with literally these 2 questions, and says, by the way, you can buy so many of these, but your target is much more. right? Once you know what your target is, the stupid thing that you see on these ads on television is what's your target retirement wealth number, right? It's such an idiotic comment because if interest rates are 5, my target wealth is very different from if interest rates are 0. But we're allowing people to have these advertisements on television as opposed to saying, what's my target retirement income? How many bonds do I need to buy? Guess what? You needed to buy 250. You only bought 200 and you're 57. You better start saving more, right? So we can change behavior by actually giving people much better information than they're being given today. And so that's where I'm optimistic that whether or not it happens in pillar 2 or pillar 3, the regulator is now going to be able to look at everyone's accounts on a mass scale and say, guess what? People are telling us that this is their target and they're tracking way lower. We need to do an education campaign and get people to start to save more. In America, everybody goes and puts everything on their credit card and they're surprised that we have a retirement problem because nobody's told them that their retirement account has no, retirement income that's going to be sustainable. This is what happened in Chile. People were looking at their accounts and they're saying, oh my goodness, I've got 4 times my current salary. And this happens in Australia too. And they're 55 and they think, oh, I'm really rich. And they go and spend it all. Right? They go on a cruise or whatever. And then suddenly they realize, my goodness, in income terms, that was, like 1/10 of what I have. So the idiocy of what we've done because of bad finance theory focusing on wealth has caused all these bad behaviors, which I think we can partially fix. I'm not claiming we can solve all of them, but let's start giving people targets that they can achieve in a manner in which they can absorb them.
It's a great message, Aaron. It's your
product that we have here, which are doing nothing for us, right?
Yeah. It's a great product, great idea. Henry, you got your hand raised, and then Chris, and then we'll have to wrap up, I think. But yeah, Henry, just quickly.
Very quick one. I mean, this business about moving the Treasury on. The Treasury got a big problem down the line, and there's no natural buyer for their gilts. If all these DB schemes fold into insurance companies that don't buy gilts, who's going to mop up the excess capacity for gilts? There isn't anybody. The government may well look at something like this as a plan B for when the DB schemes aren't there buying their gilts. That's just the point. And I'd be interested in your view on that, Aaron.
It's actually interesting because, I was talking to the Italian Treasury and the French Treasury. And, once the ECB starts to sell off all the bonds they have, who's going to buy Italian Treasury? But here's the really silly thing we found out. The reason they're hesitant to issue this bond is for accounting treatment. Okay, it has nothing to do, they agreed with the financial benefits and the societal benefits, but there's some idiotic accounting treatment. I'm sorry I'm being so aggressive, but it blows my mind that if they issue this bond, and I think somebody said this is a long-dated deferred annuity type of gilt, the amount of money they'll collect, because it's going to cost me 50 quid today to buy a stream worth 100 down the road, right? The accounting treatment treats it as if it's 100, and because they're getting 50, they're upset that they didn't get the remaining 50, because some silly method has been used to not see how your cash flows are being deferred 40 years in the future, and they're treating it as a single number today. So literally 2 treasuries have told me, if you fix the accounting problem, we would do this. I'm like, I'm not in the business of fixing accounting problems, right? You guys have got to go and tell these Eurostat or whoever these agencies are that it's completely idiotic to have that 100 number, payable 30 years in the future, treated as if it's the same as 100 today. That's just basic economics 101, which these people are stuck with. So I think if you can find a way, and hopefully there's somebody smart on this call that can actually write a paper that says, why are treasuries being bound to these silly sort of calculations and therefore not doing the right thing by their citizens, right?
Well, that's a good challenge, Aaron. Can we look at this as a...
I think it's a job for Stephen. I think Stephen Wright's going to do that, aren't you, Stephen?
Oh, come on.
Come on, Stephen. We need
Yeah, come on, Stephen. Rise to the challenge. Chris, you've had your hand raised for a long time. Yeah. Final question, and then we'll have to wrap up. But
yes, go on, Chris. Just really a quick observation on UK pension policy. Essentially, whenever they're looking for new ideas, the first place they tend to go is Australia, and the second, one of the other countries I think they take a lot of notice of is Canada, not least of course because their pension schemes are heavily invested in our infrastructure. So where are you with this concept in Australia and Canada? Because if you make progress there, I'm sure the UK would row in behind.
So interestingly enough, Australia, we wrote a note to the Ministry of Treasury. And in fact, I've asked Steve and Henry to invite Professor Anup Basu, who's visiting from Australia. He's at MIT this year, to be able to talk about this, because you're going to need somebody local to carry this off. You know, I'm a foreigner, right, for all practical purposes. I'm happy to go and help anybody, you know, wherever I can. Canada has made a catastrophic mistake because they canceled their gilt issuance. And they did it for the strangest of reasons, because the minister said, oh, they're expensive. Yeah, they're expensive if you let inflation run hot. But, you know, this is the same discussion I've been having with the Dutch, who have the same claim to Parliament, which is we won't issue inflation-linked instruments because it's expensive. But now you've transferred all the risk to individuals who are least capable of bearing it. So it's, you know, expensive to you, but you've now transferred the risk to individuals without giving them the instrument to hedge it, which means if they all retire poor, the cost is going to be double. So you have all these silly comments being made by sort of politicians, and that's going to have a severe societal impact. And so we've got to get people to stop thinking of inflation-linked instruments as being expensive, but actually as being something good, because it now keeps our politicians and our government officials at the central bank and the treasury under check, right? So this is where all of you as UK citizens have to stand up, because you're experiencing way worse inflation than we are. And this is eroding your retirement lifestyle, sadly. I'm happy to help, but I think the Australia has got such an embedded system now that changing it is going to be hard, because there are a lot of vested interests in what has already happened. I think the UK might be easier to change. I've got a lot of friends who are CI, chief investment officers of US pension plans, and they agree with me that this is an issue. So I'm hoping that at some point we can get them to sort of sign a petition that says, please do something. This is unsustainable.
Yeah, I agree, Aaron. Thank you very much indeed for your presentation. We've had lots of virtual clapping, and thanks, Eve's got a very nice note as well. Thanks, Eve, for that. Yeah, we'll link up with Anup, I think, for a session in a week or two on the Australian model, because I think that could be really, really important and really useful. Aaron, thank you so much for a fantastic presentation. Really, really appreciate that. I know it's still very early for you, and I hope you haven't got a parking ticket. If you have got a parking ticket, I will. I'll pay it. How about that?
I'll tell you what.
I don't know what the fines are locally, so that could be really bad news. But there we go.
Don't worry. I'll collect in beer when I come to the UK, when we're celebrating the issuance of selfies in the UK. And whatever I can do to help, just feel free to let me know. I genuinely think that this could transform your system.
Yeah, I appreciate it.
And I think if you could invite Sally Swaite, you know, that might be another interesting.
Yeah, we'll do that as well.
Yeah,
absolutely brilliant. Absolutely brilliant.
Okay.
But thank you everybody for your time today. Thanks for joining. Let's pray for peace in the East, and let's pray now for peace in the Middle East. Yeah, next week we should be talking about the King's Speech. So I think Henry's going to be interviewing Charles. Is that right, Henry?
Yeah.
Just before he delivers it. So there you go.
I thought Henry was the king.
Oh, no,
Henry was.
Yeah. King's Speech next week, but there we go. Anyway, thank you everybody for joining. Enjoy the rest of your day, and be safe. All right, take care.
Sounds great.
Bye.
And is there any? Oh, sorry. Yeah. If there are questions I didn't answer, just send them over, and I'll be happy to answer.
Yeah, that's fine, Aaron. Yeah, we'll do that definitely. Thanks very much. Thanks.
Take care. Bye-bye.
Bye.